Hey everyone, how's it going? It is January 17th. We just got the closing bell. It was mostly an uneventful day, just a lot of chopping sideways, but let's see where that puts us in terms of all of our major indices. So the S&P 500, you can see that we opened right at that EMA 20. We did go down below it like I thought we would, and then we traded higher and we ended just a tiny bit above where we opened. So overall, the EMA 20, at least for today, is still holding. We take a look at QQQ. Something similar happened. We opened below the EMA 8. We traded below the EMA 20 like I suspected we would, but we bounced back. Right now we're in between, or actually we're just below that EMA 8. So it did recover pretty well. We are down on the day, but it recovered pretty well. And we're sitting just below that EMA 8. If we look at our small cap stocks, we did come all the way almost to our MA 50. That is pretty significant. And we're still pretty far below our close on yesterday. And we still have a bit of a gap right there. So IWM showing strength towards the end, but it is down and we are very close to that MA 50 now. And we look at Dow Jones, we did open and close below the EMA 20, even though we did poke above it. We are comfortably below that EMA 20 now. So we'll have to see what direction everything moves. Now, the biggest clue as to what direction everything is going to move is the TLT. So TLT, we came and we touched that MA 50. We came through that MA 150, but we did bounce and we did go above it. So that's not surprising. Usually the first touch of an average line like this holds. It's very rare that we'll just break through just on the very first time. So when we looked at the SPY, same thing. We came and we touched it for the first time in a little while and it held. So this is not surprising behavior. What we will want to see is if it continues to hold, because usually what happens is either we'll bounce right up or we will keep on touching it for a couple days and then potentially break down and through. That's really what we want to look for. If the TLT starts breaking down, then all the major indices are going to start breaking down as well. So again, what we emphasized this morning is that we really want to start hedging. We want to have balanced positions in our portfolios. We don't want to get too directional. Let's take a look at how it developed intraday. And we can see that we did go down a little bit towards the open, but then we traded back up. Then we traded way back down, and then we traded back up. So we had a couple of mostly bear traps. We got a bear trap right here and a little bit of a bull trap right here. So a couple of traps, but for the most part, mostly uneventful and not a huge range today. Now it is a holiday week. We did have Monday off. So we don't expect holiday weeks to trade the same way as normal weeks. So we'll get more normal resumption of trading action later, tomorrow, Friday, but most especially for the rest of next week. So we are just really going to count. Maybe we don't get that breakdown or pull back this week. Maybe we wait until next week until something large happens in the market. And really, we don't have anything to stimulate it in terms of the economic calendar. We've got housing starts and permits, jobless claims. Those lately haven't been really moving the markets very much. We've got existing home sales that will really only affect the home builders and real estate. So there's not too much happening this week that is really going to give us a stimulus in terms of moving the markets in a certain direction. We are starting the earnings season. I guess officially, I think today was the beginning. Let's take a look at what we have on the calendar in terms of earnings. Let's say this week and in the United States. And let's just look at S&P 500 for now. So yeah, just 2 pages. So no more than 40 in the S&P 500 and no more than 60 overall. So it's not yet a really big deal. We don't have a lot of companies reporting yet. Although when we look at this, we do have a lot of financials. So generally earnings season starts out in the financial sector with banks. So we are getting that, and we will probably start seeing some volatility here in the XLF. You can see that this bar was bigger than the bar yesterday, but not too much bigger than any of these other bars. So we really haven't seen the volatility really hit in the financial sector yet. But once it does, if there's a lot of surprises, we can see VIX starting to pop up. And we can see that today, the last 2 days, actually, we have been jumping up. We did go as high as about 15, and that is significantly higher than where we were over here. You may remember a couple weeks back, 2-3 weeks back, we started to put on VIX calls. So those lost a little bit of money in terms of time value over the last couple of weeks. But right now we should start to see those get back into break even. And if we do get into the 16, 17, 20 range, those will become very profitable. So just hang on to them. Those are really designed as hedges against other positions, but you may have taken some positions off and kept that VIX on, which is okay. That's fine. So that becomes more of a positional trade, but we will likely start to see VIX start to move up, especially if these indices start breaking down, heading towards the MA50s or below. For sure, then we'll see those VIX pop up. Let's take a quick look at the Fed Watch tool and see how expectations are progressing. So yeah, we're basically now in January not expecting a rate cut at all. That is a big difference from, well, a month ago we were saying 10% or a 10% chance of a rate cut. If we saw about a month before that, they don't give us more than 1 month back, but more than a month ago, there was like a 30% chance. And so expectations are starting to come into line, like we've been talking about for at least 1 or 2 months now. And we look at the March, there's sanity is starting to come back into, rationality is starting to come back into the markets. So we've got a 58% chance of a rate cut in March as of right now. And yesterday it was 65. So it is coming down quite rapidly. A month ago, actually about a month and a half ago, we were looking at about 85% chance of a rate cut. So finally, rationality is coming back into the bond market. We're really starting to understand, hey, these rate cuts aren't going to happen anytime soon. And the more we wake up to that, the lower these probabilities go, then the more we're going to see that TLT break down. So my personal belief is that this MA50 is not going to hold because we're going to start to understand that a rate cut is not coming in March. I wouldn't be surprised over the next couple of weeks if this percentage reaches about 30%. So once that happens, we're going to have that breakdown in the bond prices and expectations of higher rates for longer, which will put a damper on all of the indices. And we could see that pull back to at least the MA50. And so for now, I would just take very light positions, very cheap hedges on the QQQ, SPY. So a little bit farther out of the money, but give yourself some time. So at least 3 months of time in terms of expiration in order to take advantage of those out of the money puts that would have a really good reward to risk ratio. Other than that, I think we've covered everything I want to cover. And I mean, we have got a pretty good dial on what's happening in this market. We do still see sideways movement mostly in the market. So we are still just on this down leg in the sideways movement of the S&P 500. We really have to break this 467 level for us to really say, hey, we're pulling back, moving towards that MA50, and then we'll have to see if that MA50. So for now, it is still chopping sideways. It's still movement within the channel. And so we can't say that it's pulling back yet. But if those bonds break, then we can really expect that pullback. So position accordingly, be careful, don't go full size in this environment unless you are balancing it out with an opposite trade or hedging that position. So that's it for today, and I'll see you tomorrow morning at the open.